A 15% net profit surge should make stocks soar. Yet, IBM reported this exact figure before experiencing a massive valuation correction. Wall Street ignored the headline earnings beat, leaving investors wondering why. Is the broader market wrong about this tech giant, or is a hidden $66.4 billion debt trap about to destroy shareholder equity? Proper stock market analysis changes everything. Top-line revenue increased by 9.5%, painting what looked like a flawless growth story. A revenue jump of 9.5% typically signals unstoppable momentum. However, the reality of this earnings report is dangerously lopsided. This headline beat was heavily propped up by a 51% surge in IBM Z mainframe sales. Hardware refresh cycles provide temporary sugar highs, not the permanent software revolutions that drive long-term multiples. Relying on cyclical hardware spikes leaves your investing strategy exposed when the inevitable revenue vacuum follows. To grasp why the stock dropped, look at the debt avalanche funding their pivot into data streaming. Total debt jumped by $5.1 billion in 3 months, following the $10.4 billion Confluent acquisition cost. This pushes the total debt mountain to a staggering $66.4 billion. The result is a highly leveraged debt-to-equity ratio of 2.01 times. The debt-to-equity ratio simply compares what a company owes to its net worth, revealing financial risk. Wall Street sees this 2.01 times leverage and immediately prices in liquidity concerns. But the real anchor dragging down this cloud dream is the consulting segment, posting a meager constant currency growth of just 1%. If consulting engagements stall today, highly profitable software deployments accounting for 44% of revenue will stall tomorrow. Relying on one strong division while ignoring structural IT spending weakness is highly dangerous for rigorous fundamental analysis. This brings us to the elephant in the room. IBM paid out $1.576 billion in dividends against only $1.216 billion in generally accepted accounting principles net income. Therefore, the dividend payout ratio sits at an aggressive 129%. The dividend payout ratio measures the percentage of earnings paid to shareholders, warning if a company is overextending itself. You might assume a 31-year dividend growth streak guarantees income. However, structurally paying out 129% of reported earnings to keep shareholders loyal is a massive red flag. Combine this with a liquidity squeeze where the current ratio sits at 0.80 times. The current ratio measures a company's ability to pay short-term debts with short-term assets. With $31.9 billion in current assets struggling against $40.1 billion in current liabilities, there is zero margin for operational errors. This is exactly why portfolios stagnate when buying for yield while ignoring balance sheet health. How did management claim a highly touted operating margin of 13.4%? By aggressively backing out $646 million in acquisition costs and $96 million in retirement expenses from official figures. Wall Street penalizes this adjusted earnings smokescreen. Following relentless acquisitions, goodwill and intangible assets make up a concerning 57.2% of total assets. This represents an $89.3 billion goodwill bubble waiting for an impairment charge. A core tenet of value investing is that when serial acquirers rely on historical valuation models, integration failures could destroy your equity overnight. Despite these metrics, a hidden financial strength prevents a severe market downturn. Operating cash flow came in at a robust $5.169 billion. This proves the underlying cash engine is not broken, providing necessary liquidity to eventually digest that immense acquisition debt. So, why did the stock drop after a massive earnings beat? The market looked past the temporary hardware high and saw a company teetering on a highly leveraged tightrope. While exceptional cash conversion defends its valuation floor, the stock remains dead money until management proves genuine organic software dominance. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath, the incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything, into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives, and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that. Noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.